Kenya Power says its earnings for the financial period ending June 30th, 2019 will be more than 25% lower than last year. In a profit warning issued Thursday, Acting Managing Director Jared Othieno, however, says they have a strategy in place to return them to profitability in the long term. Faisal Ahmed with the details.
The notice by the utility service provider cements the rough financial path it has been treading on for the last 2 years. Managing Director Jared Othieno, in an advisory to shareholders, says the dropping in profits is attributed to, among others, increasing in non-fuel costs in line with their strategy. This the second financial year the distributor has issued profit warnings. This, analysts are now warning, could mean worse days for the listed firm.
Because if they don't sort out their debt problem, it is currently their major headache. And in the next 2 years, between 2 and 4 years, they've close to 57 billion, which is due for repayment. If you look at their balance sheet, they will actually not be able to pay that money.
The long-term strategy by the company to grow cheap and clean energy, he adds, may be welcomed by customers but unhealthy for Kenya Power books. This on the backdrop of the government's plan to provide renewable and affordable energy.
With such an amount of debt, they really need to restructure their debt, and we might have to be prepared for maybe 3 years, 4 years of rate hikes. So they need to tell the government this cheap power that you have been promising people, tell people it's not possible. They actually need to increase their rates so that they can increase their revenue.
Last year, the firm blamed prolonged electioneering periods, harsh weather conditions, as well as an economic slowdown for the reduced earnings. Going forward, Othieno is confident that their strategy on long-term reduction of cost of power to customers would yield long-term profitability. Faisal Ahmed, Citizen TV.